I like to refer to it as good dividends. And by good dividends, I mean dividends that, first and foremost, the company can afford to pay. And the first thing you're looking at there is, are the earnings that this company is making exceeding the dividends that they're paying? You would tend to assume, well, of course, but as you'll discover, that it isn't always the case. The second question is, are they sustainable? And the third thing you're looking for is dividends that don't inhibit growth. So I'll start by looking at the payout ratio. The payout ratio is simply the dividends per share divided by the earnings per share. And what that means is, of the profit that a company makes, what percentage does it give to its shareholders, and what percentage does it keep to reinvest in the business? If it's paying out more in dividends than it earns, that's obviously not a sustainable strategy, because those funds have to come from somewhere. Ideally, we're looking for businesses where the dividends are going to grow, but grow in line with the earnings of the business. Some companies will try and maintain a high yield in the hope that that makes them more attractive to investors, but this is a wealth destroying strategy, as the dividends have to be funded. And we'll run through some examples of how this happens. And we'll start with a fairly well-known company, that's CSR. So what I'm doing now is I'm going back into Skaffold and I'm bringing up the company CSR. And I'm going to start by looking at its earnings and dividends screen. Now what you'll see over here in more recent years, 2010, 11, 12, is that the dividends have exceeded the earnings in each of those years. Okay, that raises one red flag. The next thing we do is we have a look at the capital history. And what we're looking for here is just to see what the funding of the business is like. And we can see that they have reduced all of their debt, which is, or the majority of their debt, which is good. But let's have a look at the cash flow. Okay, so the cash flow is showing us that in the last couple of years, the company has been paying out more in dividends than it's been earning in profits, and that has impacted on the cash flow. There was a big spike in terms of the funding surplus, but that was reflective of they sold off a division and therefore raised a whole lot of capital that way. And then the next thing we'll look at, of course, is the Skaffold line. And the Skaffold line, as will probably come as no surprise, is going to reflect what happened to the business over time, and that is that it's been a slowly downward trending situation over the last few years, as you can see here. This is what happens in a business like CSR. It was paying a good dividend yield. However, it wasn't able to fund that dividend from the earnings of the business. Over time, they had to draw into their cash balances to fund that dividend, and it gradually diminished the value or the worth of that business. So that's the type of situation that we're looking to avoid. Paying out too much in dividends can also inhibit a good company's growth. Ideally, you want the situation where a company has the ability to invest in growth and expansion and continue to earn high rates of return on that investment. The investment needs to be funded from somewhere, and so companies have three choices whenever they're considering a new investment. One is to fund it from retained earnings, so that's profits that they keep within the business. Another is from new capital, new equity capital, and the third is from debt. Now, the last two options are likely to be more expensive or involve more risk. Reinvesting funds from retained earnings is usually the best option, but it can't be done if those funds have already been distributed to shareholders. A very rough rule of thumb is that if a company can maintain a return on equity that is higher than what you could obtain investing elsewhere, then it's in your best interests if that company pays out less in dividends and keeps more to reinvest itself. The idea being that you are ultimately the owner of that business. You want to invest in the highest possible return. If that company can access higher returns than you can, then they're better off keeping those funds on your behalf and investing them. where they can earn a greater return.